Good morning. You're watching Business World Live. I'm Danie Laurel. We kick off this morning's broadcast with another bleak outlook on the economy. Fitch Solutions has slashed its 2021 growth forecast for the Philippines to 4.2% from 5.3%, saying the country's recovery continues to struggle on the back of new COVID-19 outbreaks. Now, the think tank says that while the economy rebounded to an 11.8% annual growth in the second quarter, weaknesses were evident in the 1.3% quarter-on-quarter contraction due to mobility curbs during this period. Fitch Solutions says the domestic economy will face continued disruptions from the pandemic given the slow pace of vaccination and difficulties in containing the outbreaks. It says the country remains a long way off from reaching herd immunity, noting that only about 10% of the population has been fully vaccinated. Fitch Solutions also flags the new round of strict quarantine restrictions in Metro Manila, as well as the Delta variant. It adds recovery will be delayed into 2022 as the economy is still hampered by lockdown measures this year. NEDA Chief Carl Kendrick Chua acknowledges the effects of the quarantine restrictions and says economic managers are pushing for the further reopening of more sectors to avoid economic scarring. Now, foreign direct investment inflows dropped in May to its lowest level in over 1 year as the emergence of new COVID variants weighed heavily on investor sentiment. FDI inflows fell by 25% to $429 million in May. That's from $575 million in May of 2020. It was also about 37% lower than the $679 million inflows recorded in April. Now, May's figure is the lowest FDI print since the $317 million inflows in April of 2020. But despite the decline in May, year-to-date FDI net inflows still rose 38% to $3.5 billion from the first 5 months of 2020. And for the full year 2021, the Bangko Sentral expects FDI net inflows to reach $7.5 billion. Checking in on the indexes open this Wednesday, that's after markets had reversed their reaction yesterday to the higher than expected but still sequentially lower second quarter GDP print. And you can see a little bit of cheeriness here. Our index up by 0.15% here to just above 6630 levels. And you can see here on my terminal which ones are moving the bourse up, and you can see DMCI holdings up by 3 1/10 or 0.2% together with Emperador, BDO, and LTG Group. Now on the downside, you've got ICTSI continuing with that slump, dragging down the index together with San Miguel and Ayala Corporation. Now there is one sector that is very clearly in focus today, and those are the banks here. And you can see on my terminal here the outstanding loans of the banks just continuing to go down, but towards the tail end of my graph here, you can see a little bit of a tick up. Now, June non-performing loans were up by 73.9% year on year to the tune of 483 billion pesos. That's according to Bangko Sentral data. And those bad loans also inched up 0.7% month on month. However, despite the increase in the bad loans, the NPL ratio slightly eased. So we are now at 4.5%. Or 4.48% to be exact, from what we had as a 13-year high of 4.49% NPL ratio in the month of May. Still, if you compare it to last year, we saw in June an NPL ratio of 2.57%. So we are still much higher than last year. Now recall that BSP officials are looking at a little over 5% in non-performing loan ratio by the end of 2021. Moody's, meanwhile, is saying that the muted demand for a consumption-driven economy like the Philippines will impact the debt repayment capacity of a lot of borrowers. Another thing very interesting to be watching out for is the loan portfolio of banks in the month of June. That went down by 0.4% year on year to 10.8 trillion pesos. Month on month, however, it did go up by 1%. Still, it is a 7th straight month of a drop year on year. Now, this according to AIM's economist John Paulo Rivera. Months ahead we will have concerns on the asset quality. It will continue to affect the bank's risk appetite to extend more loans. Still, very interestingly, despite all of that, you've got the profits of the banks continuing to jump. The total profits of banks jumped to 122.7 billion pesos. That's up by 43% year on year in the first half of the year. This is from Bangko Sentral data. They're saying that this is due to lower provisions for the credit losses from the banks, but they did have to write off a lot of bad debts. That tripled to 4.94 billion pesos in the first half, and what in terms of what they had to write off due to the provisions in Bayanihan 1 and 2. And speaking of banks, finally, just a quick peek on the best performer this morning. That's PNB, up by 1.5%. This as they announced their first half net income to the tune of 22.1 billion pesos. Their first half net interest income was down by 3% to 16.9 billion pesos, but they did have a one-time gain which boosted their profit. They did or at least rose in fair market values, 3 prime real estate properties which were transferred to BNB Holdings. They did also mention that their net income was 16 times higher than 1 year ago, even as the trading and forex gains fell 57% year on year. PNB trading at 20 pesos and 80 centavos. Here are the other headlines we're keeping our eyes on. Cash aid distribution for ECQ hit residents in Metro Manila begins today. Each qualified resident will receive 1,000 pesos in cash, while each family can receive a maximum of 4,000 pesos. Now, President Duterte earlier said he would ask the DILG and the DSWD to take over the handling of the ayuda payout in one particular LGU. But the DILG said they have yet to receive official orders to this effect, so the ayuda distribution in all cities and municipalities in NCR are still being handled by the LGUs. Now, the government has created a new task force to streamline efforts on economic recovery. This comes as the number of temporary unemployed reached 400,000, while an estimated 200 billion pesos in revenues have been foregone due to the lockdowns. Interagency Task Force Co-Chairman Carlo Nograles said that the National Economic Recovery Strategy Task Force would lead strategies to help boost the economy. These include providing wage subsidies to private sector workers, loan assistance to affected establishments, as well as deferment of fees, among others. Nograles also announced that the government has so far administered over 24 million vaccine doses to Filipinos. 13 million have received their first doses, while 11 million are already fully vaccinated. He added that the government is targeting to vaccinate 50 to 70 million Filipinos to achieve population protection. A rebound is not a recovery. This is what IBON Foundation is cautioning amid a double-digit GDP growth print in the second quarter. Here to help us navigate those risks, we have with us Rosario Guzman, Executive Director and the Head of their Research Department. Good morning, ma'am, and welcome to Businessworld Live. Ma'am, I think you might need to unmute your microphone.
Sorry. Good morning, Danie, and to all our viewers. Good morning.
Good morning, ma'am. Ma'am, of course, the growth for the second quarter, if you can even call it growth, was largely expected to be in positive territory because of the fact that the economy had contracted 17% in the second quarter of last year. But of course, you did mention that quarter on quarter, it's a clear indication that we had reversed the trend of seeing a quarter on quarter growth in the first quarter versus another contraction, 1.3%. What do you think happened here, and is this a temporary bump considering that there is still an ongoing ECQ in the capital right now?
Well, we are comparing the second quarter of 2021 to the previous year, and what happened here is that we have what we call the base effects, where we have a very low base in 2020 where the economy contracted by 17%. So just to illustrate, in the second quarter of 2019, for example, we had 5 trillion pesos at constant prices of gross domestic product. And then on the second quarter of 2020, it went down by 900 billion. We lost 900 billion in the economy. So that's 4.1 trillion pesos at constant prices. But now they're saying that, we are recovering because we are reaching about 4.3 3 trillion pesos. So that's not really recovering the pre-pandemic level of 5 trillion, but it's just registering about 11.8% growth, comparing to a very low base in 2020. So that's why we said this is not recovery. It's just a simple rebound coming from a very low base. And if it's really recovery, we should have grown by about 22%, which is not happening right now. What just happened here is that there is less restrictions in this quarter that is being compared to a very restrictive quarter in 2020. So when we look now at the third and fourth quarter of the remaining quarters of 2021, we should be registering about 25% growth, which is of course really far off. So we're not
Quite
even
high.
halfway
Okay.
to, yes, to recovery.
Okay, ma'am, however, can you say that in the third, if we're looking at what you mentioned, a continued strain and a continued contraction, NEDA Secretary Carl Kendrick Chua did mention that now at least we're getting used to the lockdowns. The ECQ is better managed this time around. We still have public
Mhm.
transport. It's not a total shutdown. The ayuda is being managed digitally. There's vaccinations right now, which we didn't have before in the
Mhm.
second quarter. Can you say that at least the pain might be a little bit more managed this time around?
Well, actually, we have three indicators that this is that what Secretary Chu is saying is not the reason for this so-called growth on the second quarter. The three indicators would be one, the government is not really spending so much. If we compare its spending in the first 6 months of 2021 to the previous first 6 months as well of last year, it only increased by around 9.4%. You see, the government spending is even lower than the annual average growth of spending of government, even pre-pandemic. The annual average growth then was 13.4%, but government is just spending 9.4%. Very, very low spending. And also, if you look at the GDP, even government consumption in the GDP has gone down. And when we say it has the growth has slowed down, NEDA is saying, "Oh, that's coming from a high base." So why isn't NEDA saying that the high growth rate in the GDP is also coming from a low base? You see, what we're saying is
Okay.
one, the government is not spending so much, but the more important indicator, I think, is that despite this 11.8% growth in the GDP, we are seeing jobs losses. You see,
Mm-hmm.
the increase in unemployment. Let's say the average unemployment in the last three quarters of 2021 is even slightly higher than the average unemployment rate in the first three quarters. So it's not really improving in that sense. And if we compare it to pre-pandemic, we even lost 1.5 million jobs in this regard. So you have an economy
Okay.
that's registering growth from a low base, and you also have unemployment really worsening.
Ma'am, can we dive deeper into the unemployment? Because the figures are always different. They've said,
Mhm.
of course, 400,000 displaced jobs, but they're saying that's temporary. And of course, when we look at it from a long term perspective, they have said that at least the jobs that have been lost since the beginning of the pandemic are slowly recovering. Can you add
Mhm.
more detail to that? How many, without having to delve into exact
Mhm.
numbers, in terms of how many jobs we've lost since the beginning of the pandemic and how many are slowly being recovered with or without this temporary losses in the 2 week lockdowns,
Mhm.
etc. Are we
Right.
on a path to actually getting back to where we were?
Yes, so to answer that immediately, no, we're not on that
Okay.
direction, not even with the GDP. But in terms of employment, as I said, the increase in unemployed, in the number of unemployed from January 2020, which is pre-lockdowns and pre-pandemic and all that, was just 1.5 million. Sorry, yes, 1.5 million. But NEDA is now saying that there is an increase of 1.1 million of jobs. So that's why you're saying now that there are 400,000 still to be
Correct.
recovered.
Yes.
The problem with that is we are not sure if it's the same job we lost that is being recovered. So let me just focus now on what is employed at this point. And we are witnessing here a very worrying trend where the number of employed is actually increasing in very low quality kinds of jobs. So, for
Jobs.
example,
Okay.
we are seeing the decrease of full-time workers, but the increase of part-timers. We are also seeing the decrease of wage and salary workers, which are assumed to be formal and to be regular, as against the increase in self-employment and informal workers. So, to put it simply, people are going into informal jobs or to low-paying jobs or low-quality jobs and making do with these jobs because there are no formal and regular and decent jobs to be found.
Okay, understood. So the figures are not necessarily, painting the full picture here because of the fact that they're not getting back their normal jobs. Ma'am, other think tanks have said it might take us 3 to 5 years to get back to pre-pandemic levels. Can you pitch in on that now? Is there even any way to understand how far along we are in the path to recovery? Is it 3 years from today? Is it 3 years from the start of the
Mhm.
pandemic? And what catalysts are you watching out for closely for this number to be closer to less than three or closer to five?
Yeah, actually, in simple projection, if I said earlier that we needed 22.5% growth for second quarter, in order to sustain that, then it should be within that level or higher than that. And I think even the Asian Development Bank has already uh, given up on that kind of projection and has already lowered its projection that the Philippine economy will just achieve around 4 to 5% growth in the GDP. But there are other projections. Yes, as you mentioned, I also heard that even rating agencies, even if they rated us high, are saying that it will take about more than 5 years for us to recover 2019 level. But
Wow.
for IBON, that's not really the projection is not when will we reach 2019, because even then in 2019 we were already saying that the economy has been slowing down for 3 consecutive years already. So what we want to see is that how people can regain the lost incomes and lost jobs, and we can only say at this point in the pandemic that government has to spend so much for ayuda, for social amelioration, and for economic stimulus, which the government is not doing. So if government only put in, for example, last year around 1.6 trillion pesos, or even half of that, because we budgeted 1.1 trillion for a irrelevant infrastructure program. If only half of that were given last year, which what we lost in the GDP, annual GDP in 2020, then it could have stimulated the economy. It could have helped consumption, driven consumption, and even and yeah, eased restrictions to small businesses. But
Ma'am,
that did
is
not
the
happen.
government able to spend more at this point without having to find more sources of income via, tapping into even more debt or raising taxes? Do they actually have that in their arsenal right now that you believe is just simply not being spent? And why is this? Are they waiting? Some have said that they're waiting for the economy to reopen before all the stimulus is granted.
um, when you look at the 4.5 trillion budget, for example, we are seeing here huge amounts being allotted to build, or to infrastructure development. Another 1.8 trillion, for example, being allotted for debt servicing. So obviously, the government is so obsessed, or maybe just single-minded about credit worthiness, the showing the creditors that here we have really allocated so much for business confidence and allocated so much for lenders' confidence or creditors' confidence. So it's not going really to a productive allocation where people can be motivated to consume, or even workers are helped to to get by while waiting to be called again for work. Those are not the spending that we see, not even in the 2021 budget or even in the 2020 budget. So yes, the
Okay.
money is there. It's not just being allocated for to the correct
Ma'am, to
sectors.
clarify, are you saying we should possibly risk the credit rating to have a higher spending in other sectors instead of financing the debt and the and maintaining our debt to GDP ratios at a lower level? Will the credit ratings be agencies be happy with this? And are they? Do you think that they're actually happy with the second quarter GDP print?
I think both sides are happy, the creditor and the borrower. On
Okay.
the side of the creditor, of course, the creditor would always want to go on with the lending business, which is you're in need, then continue to borrow, and then the borrower will always go on with the borrowing business because only by borrowing can I prove to you that I can indeed borrow and pay for what I borrow, and just to look at what we have borrowed so far in 2020. For example, if we look at the COVID borrowing, apparently it's just 8.3% of, for example, of the official development assistance loans that came to us were actually channeled to COVID response. And 63% will just be for budgetary support, they call it, which means it's just to beef up or to cushion the impact of the pandemic on big business and on the budget itself, which is being allocated for infrastructure and debt servicing.
Okay, so there is a need to re-examine where the money that we actually have is being spent, and as you mentioned, increases 8.3%, which is being allocated to the COVID response. Thank you so much for those insights. Of course, that was Rosario Guzman, Executive Director and Head of the Research Department of IBON Foundation. And that's a first look into the business day. Today's Wednesday, August 11, 2021. Catch Business World Live for the market closes at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.